Hello, I'm Kelly O'Byrne and welcome to LCG's preview for the week ahead. I'll be talking about Friday's non-farm payrolls report, new record highs in the UK stock market and the crash in the Turkish lira. Before that though, I'll run down some of the top corporate results to watch for this week. Starting on Tuesday, Salesforce report first quarter earnings. On Wednesday, Michael Kors and Box report quarterly results. On Thursday, First Group report full year earnings, followed by Lululemon, Dollar General, GameStop and Costco's first quarter numbers. Now moving on to the economic calendar, there's not much in the way of market moving data until Wednesday's release of preliminary German inflation for May, German unemployment, Canadian first quarter GDP, US first quarter GDP and the Bank of Canada rate decision. On Thursday, there's Eurozone CPI for May, followed by US core PCE inflation. Finally, on Friday, it's US non-farm payrolls, with US ISM manufacturing following shortly afterwards. A quick FYI also, there'll be no NFP webinar this month. Non-farm payrolls expectations indicate 193,000 new jobs created in May, up from 164,000 in April. The report takes on extra significance in the context of the massive rally in the dollar over the past month. The 3-month average for US job growth does seem to have slowed, so a big miss in the headline number will fuel concerns that this slowdown is more permanent and could send the dollar lower. On the other hand, wage growth is the most important for monetary policy. Earnings growth of 0.3% month on month or more will likely result in dollar strength if the jobs number is within 20,000 of expectations. It's been a very strong period for the FTSE 100, where 8 weeks of gain took it to its record highs and saw it outpace other indices in US and Europe. But the winning streak looks fragile. The drop in the pound, which we all know by now helps UK-listed multinational firms, and the rise in oil prices, which helps heavily weighted energy and commodity companies, have been behind the outperformance. It's for that reason that the trend higher in the FTSE 100 directly depends on the direction of the pound against the dollar and the direction of Brent crude oil. Both sterling and oil are trending strongly but look overextended, and corrections would likely mean that the FTSE retraces some of its recent gains. On a more technical basis, the FTSE 100 needs to maintain its recent breakout of 7,800. Last week's most notable price mover across the forex space was the Turkish lira. The lira, like almost every other emerging market currency, has been under pressure from a rebound in the US dollar. A strong dollar makes it harder for many of these emerging economies to repay dollar-denominated debt and often means fund outflows from the international investments that could have led to economic growth. The lira selling went into overdrive after comments from Turkish President Erdogan implicitly signalled an intention to intervene in monetary policy. High Turkish inflation dictates higher interest rates, but Erdogan wants growth-friendly lower rates. If Turkey no longer has an independent central bank, it could result in very high or even hyperinflation, which by its nature wipes out the value of the lira and any investment based in the currency. The central bank has already responded to market pressure by raising rates in a sign that Erdogan has accepted he cannot control the market. The research team here at LCG think the central bank will continue to hike, much like we saw in Russia following the introduction of sanctions, until the lira stabilises. The initial reaction to the rate hike was more losses in the lira. Seen as an act of desperation, this implies it could be a few more days or even weeks until the lira finds an interim bottom. That's all for this week. If you wish to see these videos as soon as they're released, please follow LCG on social media. Thank you for watching.